Not every structure shift that you see in a market is actually going to follow through with a full-blown reversal. Sometimes it's what we call a sweep of liquidity, and the market will reverse from the point that structure broke and end up moving the opposite way to the one that you expect. So in this video, we're going to break down the differences between structure shifts and sweeps of liquidity, and I'm going to show you a few different scenarios in markets where market structure shifts are less likely to result in reversals and more likely to reverse into sweeps. Let's get to it. To understand structure shifts, you need to understand market structure dynamics. We have in uptrends, continuation impulse moves, which are going to be the upward movements that are creating breaks of structure. These are in itself kind of small structural shifts taking place where the market shifts from the corrective move, the pullback, into the next impulsive move. A standard structure shift, however, is generally where we see a reversal in the market. It's an area like this where an uptrending market shifts from higher highs and higher lows into a lower low. Generally, what is expected from a structure perspective from this point is going to be a pullback to form a lower high and then a continuation lower. It generally, when we see a structure shift like this, a market shifting from higher highs and higher lows into a lower low, will set in motion a new downward trend. The same goes if we're looking at a downtrend, shifting with the market structure shift into an uptrend. After creating a higher high, we would generally expect the market to create a higher low here and then continue higher. But not every single market structure shift that we see, not every single seeming reversal, will actually lead into a notable reversal in the market. In fact, sometimes what we do instead is actually just sweep a low, so we come through the low, create what looks like a reversal, and then we end up going back the other way with the overall predominant trend. A lot of traders get caught out at these points because it looks like the market's reversed, but then it reverses on you again. And if you try selling in this price range, expecting the market to go lower, well, you get crushed because the market doesn't reverse the way you want it to, and it actually just continues trading higher. So there are ways that we can spot when this is a sweep versus a reversal, and when a structure shift is going to lead into a reversal, and when it's not. And that is what this video is all about. The first example we're going to look at is this USD JPY position. We can see that this market is predominantly moving to the upside. It's created higher lows and it has a couple of higher highs printed as well. So as a trader, you may see this area here as a higher low, and you may expect then if we break through and create a market structure shift above this high, we could look safely for buys to continue taking this market higher. That would be the standard logical thing to do from a market structure perspective. But this is actually what I classify as range liquidity. Now, when we talk about liquidity, liquidity simply refers to orders in the market. It's areas where there's a significant number of stop losses, buy stops, sell stops, basically just money. Now, these orders are where the more significant reactions and reversals in markets take place. Because essentially, if there is a massive amount of buying orders here in the form of stop losses for sellers and also buy stops for breakout traders, then we know if you wanted to sell this market, there's going to be a huge conflicting number of orders here for you to take the other side of that trade, right? If there's loads and loads and loads of people automatically buying here, you can sell into that and you've got a lot of people taking the other side of that trade. So markets react most significantly to points of liquidity. Liquidity comes through in the market in equal highs, equal lows, trend lines, but also just range liquidity, which is notable highs and lows around confined ranges in a market. So we would have a range low here, and we would have our range high there. And essentially either side of this range, we have what we classify as range liquidity. Now that is why this liquidity works, number one, because the market is drawn towards these points, and then these points are where the significant reversals take place. So that's factor number one, but that's not exactly going to save us when it comes to actually identifying where this liquidity is. So that's the theory behind it. And now when it comes to actually identifying this range liquidity, we need to get a bit contextual. So what I like to do is always think of the market in broader narratives. I like to look at a market and decipher where is the market likely to reverse from, where does the market change direction, and where is the market's most likely next large movements going to come from. Well, when we look at this market, we of course worked out that it is indeed in an uptrend. So we can assume that this will continue buying. Now, generally inside of an uptrend, I like to see the market react from a supply or demand zone. So a supply or demand zone, for reference, is going to be a candle just before an impulsive move, like this. So we have this area here, consolidation, and then we have this impulsive move to the upside. So down here would be an area of demand. Now, what an area of demand shows is where significant buying is taking place in the past, which tells us essentially this is an area that was seen as a discount price to buy this asset. We know that because there was loads of buying taking place from this level, which then leads us to believe if the market was to get back into this level, we would see traders jumping back on this discounted price again and looking to take this market higher, specifically in an uptrend, okay? So that's what a demand zone is. I generally want to see my buys taking place from demand zones if we're looking for a significant swing move like this uptrend that we see on USD JPY. So I'd be looking inside of this range for a demand zone with imbalance into it. Now, imbalance is simply an open price range. So if we take a look here, all of this move, in fact, this is an open price range. It's imbalance. Basically, we have demand, we have a push away. This has not yet been filled in and retested, so that leaves an imbalance. But if we look in this area that I've just covered, there's no imbalance in here. Every little demand zone that's been created has been retested by a wick. So essentially, what I can tell from this, if we're getting contextual with it, is there is no significant area of demand inside of here. Now, if I'm looking to buy this market and there's no significant area of demand to buy from, well, maybe I'm going to see this and think, I'm not expecting really then for the market to react from that point, because there isn't a significant point in here for the market to actually collect significant buying liquidity or significant buying strength in the form of demand from a discounted price area to actually make a movement higher. So therefore, I may say, well, we got a couple of things here then. We may end up coming lower, coming all the way through this low. Because we still have the imbalance down here, because we have that significant demand, this market structure shift wouldn't actually significantly change the market direction. So if we ended up breaking down here, I wouldn't see this as a structure shift like this, where I'd then be looking for the market to come and print a lower high and then trade into new lows, okay? What I'd be looking for instead would actually be for the market to essentially what we call sweep this low. This one just here, because there's no significant area of demand here. There's imbalance and a significant area of demand there. What we could be looking for instead is for the market to come down to this level and then actually create a reaction and trade higher. So I've basically gathered this idea from the fact that where price is right now, although it's in an uptrend, is in a insignificant area where there isn't going to be notable buying pressure coming in. So what we are more likely to do than buy from here with strength is to actually sink lower, sweep out the next low, and when we hit the next significant demand, that can be where the buys come in. Now the question could be, isn't pushing through this low then breaking structure to bearish? And isn't it then going to be risky buying against it because we should be theoretically shifted into a downward trend? Well, the answer to that is I see this more as a sweep. So moving on from this, we're going to come back to it in a moment. Let's talk about the bigger picture context. And we've already covered we have demand. We've already covered we have imbalance. These are two very significant factors that give me confidence in taking a trade against what some people will see as a market structure shift, okay? So the imbalance is basically a magnet for price. It's an area in the market that is very likely to be traded through. So when we see imbalance like this, we see there is a very high likelihood, we'll box it off, that the market at some point in the near future is going to come and trade through this area. But what it actually does by trading through this imbalanced area is just come and fill a more significant area where new buying orders can kick in. So if we break structure straight into an imbalance, we should then, yes, have some selling on a lower time frame. But the selling we would get would generally just be to fill the area of demand. And then we would see this as our possibility to get back into the upside. Because essentially the uptrend is intact. This break, although it may change the picture for some people, will actually only be leading towards a significant buying zone. Because there isn't a significant buying zone where we are. If this market wants to keep trading to the upside, it's going to need to meet somewhere of significance before it can do that. And the next area of significance is of course going to be the imbalanced demand zone that sits beneath. Because there is no imbalanced demand here, so this range is not very high likelihood to react. So what we've done there is just talk through how we can decipher essentially a market shift from a reversal or a sweep. This one, in my eyes, would be a sweep. We'd sweep this low, we would come through this imbalance, we would hit this demand, and we would collect another huge quantity of buying orders from inside of this area, which then can drive the market higher. So we would classify this BOS, break of structure, market structure shift, as not a reversal, but more of a liquidity sweep to fill imbalance, retest demand, and then continue trading higher. Now, where would I then shift my bias? Well, if we ended up breaking through this demand zone, so if we came down like this, then I would change the narrative. I'd change my bias. I would no longer see this as a sweep, and then I would classify, okay, we can treat this then as a simple break of structure, because at this point we've broken demand, we've proven that buying is not strong. So yeah, the next likely move will be a pullback and then sell continuation, okay? So at that point, with the benefit of hindsight, which we will of course have if we fail that demand, we can take a nice calculated bet that the market is then ready to move lower. But at this point in time, while this demand zone is still intact, while this imbalance is still open, we could definitely see this as a sweep and more likely to trade higher than it would be as a break of structure that is more likely to trade lower, okay? So that is kind of trade setup number one, classifying the supply and demand. Essentially, we use concepts like that imbalance and supply and demand to filter in areas where the market will remain valid for the buy side opportunity, even if it does create what looks on the surface like a market structure shift. And we built this initial bias, remember, out of the fact that there is no significant buying area here, but there is a significant buying area down here. So if we're looking to continue this buying in this market, we need a significant buying area that's going to be there. So that's that setup. Now, let's get back to the range liquidity, because now that we've built that bigger picture narrative, we understand we want to buy this market. We understand there is buying pressure down here. We understand there is significant pressure behind the buying, right? We understand the demand is live in the market, but the demand is just not really going to be very strong from here because we didn't see very strong, clear demand zones formed from here earlier. So with our idea that we would prefer to see this market come lower, this provides a setup in itself, which again, on the surface to some may look like a break of structure, but is actually a sweep of liquidity that can open doors to trades the other way. So I said around these points of range liquidity, we create highs that are likely to be drawn towards, price is likely to be drawn towards, and we create lows that price is likely to be drawn towards because there's a lot of money down here, there's a lot of money down here, market reacts to money, orders, that's where the movements take place. Now, if our big bias is to go short, as we've just discussed, we're looking to take the market down into this area of demand due to the contextual big picture. Well, now, if the market broke structure above, we understand that there is still no clear buying area here. There's no real significant point that this market is reacting from. So this wouldn't really open doors to high probability buys because it's just not coming from anywhere significant. It's coming from what I classify or call no man's land. These reversals, these reactions, these rejections, they're not coming from anywhere notable, nowhere significant, no clear, strong demand. So instead of expecting this to trade upwards with strength, like what I've just drawn on here, this hypothetical idea we talked about, what we may expect to see instead, given that we're not seeing a strong buying area to buy from, is if the market takes out this high, it could be more likely to just react from the liquidity and then end up trading back lower down into the range low. Because again, we're going to have liquidity down there as well. Okay. So we have basically a bearish short-term picture. We want to buy it, but on this lower time frame, we've started seeing these breaks lower. On the higher time frame, we're seeing no significant area of demand. We see that beneath, we see the imbalance. We have a draw down into this level. So although we want to buy on the big picture, this lower time frame picture or this more refined picture is telling us the more likely outcome is going to be shorting into the buy zone. Okay. So if we want to take advantage of that, well, the range liquidity, where the high of the current trading range sits, if we see a reversal in there, and that's the big caveat, we don't just sell straight into this, but if we see a reversal like this, where the market structure shifts in our favor, after we've swept that high, well, that becomes a setup in itself. Because what that does is tells us that yes, this reversal is taking place and we are actually seeing a sweep here instead of a break of structure. So we would then see this whole pattern as a sweep that we would sell into instead of seeing it as a break of structure that we would want to buy into. So it really begins contextually on the high time frame, and then we can refine it in to the lower time frames or the smaller, more refined picture view to really get an idea of where those trades may take place. Now, take a look at this. We've seen a push up in this market. We've taken out the range liquidity high. So we've pushed above the range liquidity, and we have now created breaks of structure back to the downside with pretty significant momentum. See here, if we track the market structure up, we've got our high, we've got our low, we have smaller highs and lows formulating in here, and then we have a very strong down momentum move. Again, we pull back, very strong down momentum move. So what this actually does is creates what I call a standard confirmation. It's just a very simple break of structure from higher highs and higher lows into lower lows and lower highs. That's the selling example, and that is exactly what we've seen just here. There's the high, there's the higher high, there's the lower low. We then look to sell the pullback, right? So if that's what we're now seeing active in this market, well, we could expect that this is going to lead into a selling opportunity. So again, what we do here is find our clear and balanced supply. Okay, that's pretty much going to be the cornerstone of every great trade. We put our stop loss over that, and then we could target, for simplicity's sake in this trade, the range liquidity low. Because what we've done here is create a situation where we think this market's going to go lower in the short term. We've seen a sweep of the liquidity here. We're expecting a sweep of the liquidity down here. So selling into this, now that the market confirmed with the standard confirmation, like this, selling into this gives us possibility to profit from a downward move from there into there. And that, if we see how it goes, is exactly what happened. Now, very interesting follow on from this, we actually ended up getting a sweep of the range liquidity down at the low, then rallying into a push to the upside. And if we extend this out, we let this market do its thing, you're going to see that it actually goes and takes out the range liquidity high again. Now, this is particularly what we call expansion, where a market is just essentially widening inside of a trading range. But it means that after sweeping this range liquidity low, we end up pushing higher, creating again what could look like a break of structure. But what do? We just sweep and sell off once again. So essentially, because we're working with our big picture contextual narrative, which obviously is that 4 hour, we want to see this low broken, we want to see the market get down into there. We could just treat every new sweep of high that we see as another selling opportunity. And we can continue pushing towards the range liquidity, continue pushing down towards these lows with every new sweep that comes through, because we are anticipating that the big picture is going to bring us down into here before any significant buying takes place. Okay, so again, you're going to see in just one moment, we come up, we sweep the high, and we sell off once again. And we just continue doing this. We continue getting lower and lower every single time. We start coming down into these lows now, and this is where we're looking for essentially a follow through in towards our area of demand before we take these buys any higher. So that is range liquidity, which is one of the big core ways that you identify the difference between market structure shifts as reversals or as sweeps. A reversal, when we have clear buying areas, so that's a very core part of it. If this was a clear buying area and we had seen that structural movement that we saw from a clear demand zone, then this would have been completely different. This would have been a trade that we would have been quite happy to take. And I would have actually then trusted the market structure shift that came in here, which is where a lot of people will be trusting already, which is why people are getting caught out. But because we didn't have a significant buying area here, and because we do have a significant buying area down here, and because we do have significant magnet for price as well in the form of imbalance down there, we can say, yes, we are bullish on this, but the market is likely to come lower. Therefore, if I see a break of structure or market structure shift above here, I'm going to be looking at it the other way to everyone else. I'm going to be looking to take this market lower because my big picture context is telling me the possibility or likelihood of the market reversing into an uptrend from here is low, given that there isn't any significance to this buying area, but there are significant magnets on the downside that are going to draw price in before significant buying takes place. So this provides two setups where we are pretty much differentiating between sweeps and reversals. Number one, the big picture. We already discussed that breaking this structural low wouldn't actually lead into a significant reversal. It would more so lead into a fill of imbalance, basically a pull through a magnet price area, and a retest of a demand zone. And then we would be happy to continue taking that to the upside, even though on the surface this structure has broken, because it's less of a break that's leading us into a new downtrend and more of a sweep to fill imbalance and retest a significant buying area before a larger move to the upside. And the second area that we found a trade out of this same very concept was what we've just discussed here in the form of range liquidity. With that big picture context in mind, we identified an area where the market was just simply moving sideways with no clear direction as of this moment. Our bigger picture bias is telling us to take it lower. So what we can do is simply wait for the high to be swept, wait for confirmations to tell us to sell. And when they do that, we hop in there, which in this market was just there, and we get in and we just run it down to the low of the range. And again, you can get a very similar format there. We could come into the low, trade higher, buy the pullback towards the range liquidity high there if we really wanted to. If the market confirmed and told us to do that, as it did in this instance, then you could do that quite happily. And again, you can continue to sell confirmed setups down to range liquidity lows. And when we get sweeps of range liquidity lows, if the market confirms buys, there's nothing wrong with taking that side of the trade as well. But essentially, what we do is build big picture context, which is exactly what you've got mapped out there. And then with that bias, with that narrative in mind, when we know where the significant buying and selling areas are, we can utilize range liquidity for smaller kind of back-to-back trades, side-to-side trades, while we await the larger movement to come through. Now let's stupid simplify this. Basically everything we've just covered will show as diagrams, and I'll explain how we can differentiate sweeps from reversals. So the first is this one. This was kind of the big picture view. These provide some of the best setups in trading. Now we never got to see the outcome because I was showing you a real-time market, which of course, by the time you watch this video, if it's in the future, you might be able to go to USD/JPY and take a look. But basically, this is how the format works. If we've created an uptrending market of higher highs and higher lows, we've created an area of demand with imbalance. We haven't filled that in yet, so there is imbalance into that demand zone. And then we've had a rally from there, but we see that there is no notable strong buying zone in here, just like we did on the example trade, where there wasn't a clear demand. Well, what we can actually see quite often in this scenario is actually a BOS, which looks like it's going to be leading into a reversal, but actually is just a sweep, following through to finalize the move by retesting a significant buying area, such as the imbalanced demand beneath the weaker buying area above. So that right there is where we would see what can be classified as a BOS market structure shift. But in this instance, it's not really a reversal. It's just a sweep coming in to fill imbalance and hit a more significant buying area where there is going to be more demand for buys so that the move can actually finalize from there. So although it looks like a break of structure, it is more likely just going to be a sweep before a continuation of further upward moves. And the other form, the range liquidity we discussed, if there is a market range like this, sitting above an imbalance, and we have no significant reason for the market to reverse from here, and the predominant bias is bullish, then what we would actually look for is this standard confirmation pattern after we've swept that low, like so. This is how we found the short position, right, that we showed in the example, like this. And that gave us the potential to trade lower, which you can target round towards the next point of range liquidity, which would be the swing high, or extend out further if you have high probability on it bias. But that's the other point of which we do see what can be seen as a break of structure. But if it's not coming from a significant reversal point, there's no significant supply zone or notable area for this reversal to be taking place in force, and we have a predominant bullish bias, then this can oftentimes be seen as a sweep. And look, we don't have to gamble this. We don't have to just guess that this is going to be a sweep. We just wait for the standard confirmation, as discussed. And when we see that, our execution comes in around here on the pullback, because at this point, it's already confirmed that it's going to be moving in the direction we want to go in, which massively increases and improves the probability of this trade working in our favor. I hope you enjoyed that video. Hopefully there was some value in there for you. Check out the links at the top of the description for some more cool stuff. And if you don't want to do that, then click the video on the screen and watch that one. That's going to be just as valuable as this one. So thank you. I'll see you in the next video.